Welcome back to Wall Street Confidential. The question I have for you, be a bull, be a bear. Jim, I put that to you. Is it time to be bullish in this market?
I think that when we get to a 20 to 25% decline from Dow 10,000, in other words, when we get to, say, 7,500, what will happen is there'll be enough stocks in the Dow that are high yielding, that can pay that dividend, that will make it so that you're being paid for the market to waiting for the market to turn around. Now, I have been saying that if you needed, I started at Dow 11,000 and Dow 10,000. If you need money for the next 5 years, this isn't the place. That kind of valuation decline will change my view and say, okay, we're now being paid to wait for things to turn. I picked the 5 years because I think what people don't recognize is that equities are supposed to go up. We measure them as saying they're going to go up 8% a year. That's been the historic. So if we're going to go down 25%, you're basically ruining, 4 years of what you thought you could get. So if you can sidestep that and come in at a much lower level, then it's possible to resume that 8%, or at least because the dividends are so high, get paid to wait for the turn. We're not there yet. The conundrum is, it seems like we're there on the top line. In other words, you'll hear a lot of people like Jeremy Grantham, Steve Luthold. These are people who are known as being right, whether they're right or wrong, because they did sit out, in the case of Grantham, a lot of the rally. Or Warren Buffett. These guys are all saying the same thing, which is that we don't know, but we're closer to a bottom than a top. And what I'm saying is, I want to agree with that. The issue for me is that unless you're the house, so to speak, like Buffett, the distance between where the bottom is and where we are is far greater than you realize, even as it may be far less than the distance to the top. So if you wanted to look at it as a line of where we are, you would say, okay, maybe we're 2/3 down. But that last third is really horrible. And if you can avoid the last third, you should. But that there's no doubt about it, we've already entered to the realm of cheap for a lot of stocks, and I'm using the dividend as a method of being cheap. But that in the end, if I told you that you could buy a stock at 25, and I believe it'll bottom within the next 8 months at between 18 and 25, if it's 19 that it bottoms at, that's catastrophic for a buyer. I mean, that's a catastrophic decline for people, except for if you're really, really wealthy. So what I'm saying is there will be a bottom, but between here and the bottom is too great for the vast majority of people, unless you're incredibly rich or your investors are very patient.
So what do you say to the everyday investor then? You got to lose money to make money long term?
I'm saying that that's not possible, that you just cannot adopt that attitude. And because of that, I am sticking by if you need money right now, this market is not right for you. At a certain point, this market will throw off so much cash for you in the form of dividends that you will not need to worry about the principal decline. But at that point, but remember, bonds have maturity, stocks don't have maturity. But I believe that the notion of cheap and the notion of buying is a relative issue, not on the relative nature of the value of stocks, but the relative nature of the amount of pain you can take. Some people can take a lot of pain. They should begin to buy. But I'd say the vast majority of people can't. So they're following the prescription of people who can take pain. And the way I always used to view this at my hedge fund is, these are people who don't need Novocaine, the people who are buying. If you need Novocaine, then don't have, and you're not going to get any Novocaine, don't have the surgery yet.
Great analogy. Leave it at that. If you can't take the pain, then get out. And for more of Cramer's trading strategy, for a free trial, email us at action@thestreet.com.